Hi, everyone. For those of you who are joining, we're kind of slowly processing the Zoom room. Thanks so much for coming. We'll get started in just a moment. Please feel free to put your cameras on so we can feel all together. What we're going to be doing is we'll start in just a moment with Larisa. Larisa, if you want to go ahead and share your screen now, that would be great. This is going to be basically a 40-minute seminar, followed by Kevin's going to do a 15-minute discussion. We'll have some time for Q&A at the end, but go ahead and put any questions you have in the chat. We're going to be monitoring it, and if it feels like there's a pressing question, we'll go ahead and interrupt Larisa. Otherwise, we'll be able to draw on those at the end. All right. With that, Larisa, go ahead and take it away.
Thank you very much. Good afternoon, everyone. My name is Larisa Cioaca. I'm an assistant professor of management at Tulane University in beautiful New Orleans, Louisiana. I'd just like to begin by thanking Camille, Melanie, Mike, and Song for this opportunity to present today. I'm also very grateful to our discussant, Kevin, and I very much look forward to his comments. The paper I will present today is titled "The Private Value of Innovating for the Government." This is joint work with Ashish Arora, Sharon Belenzon, and Elia Ferracuti, who are all at Duke University. I think we might have Sharon try to join us in a few minutes today. And if he does, we'll ask him to just introduce himself at the end, at the minimum in the Q&A session. Now, what's our overarching goal in this paper? It is to understand how government procurement influences corporate innovation. Now, you might think, why focus on government procurement? Because it is enormous in size, it accounts for a major share of federal spending, and broad in scope. It involves firms across almost every industry. So understanding how it shapes innovation is a key policy and strategy question. Well, how does the government influence corporate innovation? Broadly, through two types of mechanisms. First, there are push mechanisms, such as grants, loans, and tax credits, which lower the cost of R&D by subsidizing inputs. There are also pull mechanisms, such as procurement and prizes, which create incentives to innovate by rewarding successful outcomes. Now, we found that these two types of mechanisms do not quite fully explain corporate R&D incentives, and our work, especially in this paper, centers on a novel mechanism, a hybrid approach, which we call the guaranteed demand mechanism, a mix of both push through R&D contracts and pull through production contracts. So let me go into a little bit of a greater detail about this guaranteed demand mechanism, and let me define it. Guaranteed demand is this implicit promise to buy the resulting products from the winning R&D contractor non-competitively, meaning without running a competition for the production stage. So the government pushes R&D by initiating early stage R&D contracts, typically awarded with competition. If the innovation is successful and the technology works, the government then pulls forward by acquiring the resulting product in production contracts. Sometimes those production contracts are awarded to the winner of the R&D without actually running a competitive production stage. And this sequence then provides a powerful incentive for firms to innovate. This linking of competitive R&D with non-competitive production contracts sort of amplifies the incentive effect for corporations to engage in government-relevant technology development. Now, I should note that the mechanism is not explicitly written as guaranteed demand in any of the government's regulatory framework, but it is built on the Federal Acquisition Regulation, or FAR. First, R&D contracts fund the development of non-existent products and services. So this is important. The government does not use R&D contracts to buy something off the shelf. It uses it to create entirely new capability. Second, a rule in the Federal Acquisition Regulation is that the output of government-funded R&D contracts must be implemented in production for the government's direct benefit. In other words, the research must lead to production the government can actually use. And then finally, that follow-on production can be awarded without competition. So even though the government prefers full and open competition in its procurement, FAR allows for non-competitive follow-on production. And let me just give you one example. If the original R&D winner can furnish that product within a required time frame, that's enough justification for the contract, the follow-on procurement to be awarded without competition. So these 3 points create the pathway for guaranteed demand. The government funds the development, requires implementation in production, and uses non-competitive production contracts to reward firms in the R&D race, thus incentivizing firms to win the R&D race. And I should know this is not a new idea. The power, the idea of this implicit promise has been recognized for decades. A famous example I brought here comes from historian David Mowry, who noted that in the case of Texas Instruments, the prospect of a substantial defense procurement contract was more powerful as an incentive to develop the integrated circuit than the R&D funding that received from the government itself. There's only one little problem here. Despite its potential importance, guaranteed demand is implicit and unobservable. R&D contracts do not explicitly, in the contractual terms, promise follow-on procurement of the resulting products without competition. Moreover, production contracts in administrative data do not formally link upstream to the R&D that led to their development. So while we believe this mechanism exists and it's important, the challenge for our paper is show that even though this promise is implicit, that it is real, and that we infer that based on the stock market response to the award of R&D contracts. And just before I go any deeper, I do want to note that if you have questions, feel free to interrupt. You might just have to speak over me as I cannot see the chat. And so raised hands are probably not something I'm going to observe. So just go ahead and speak up if you have comments or questions. So then what do we do in this paper? We're going to engage in 4 steps. First, we're going to estimate the private value of government R&D contracts using stock market returns and a valuation method that has been developed originally for patents by Kogan, Papanikolaou, Serra, and Stoffman. So we're going to take their machinery, and instead of applying it to patents, we're going to apply it to R&D contract awards. We're going to use that method on reportable, and I'll explain a little bit later what reportable means, R&D contracts that are awarded to publicly traded R&D performing firms over a 20-year period between 1984 and 2015. And we're going to look at the distribution of estimated private values and which firms appear to benefit more from winning R&D contracts from the government. We will then study the relationship between this estimated private value and future production contracts awarded to that firm. And in particular, we're going to see competitive versus non-competitive future production and where the relationship exists and where it is strongest. And then to try to make sense, we will develop a framework to try to isolate guaranteed demand from other innovation mechanisms that might be at play. You might think of tacit knowledge or temporary monopoly power. We will try to disentangle the empirical results and which ones might point to this being truly guaranteed demand versus some other reasonable explanation. And before we get too deep, let me summarize the key findings. So in case our connection gets blurry, at least you've heard what we think we found. First, we find that the private value of R&D contracts as estimated using stock market reactions is high, but very skewed. So on average, it is $466 million, or in relative terms, 19 times the potential revenue from the contract itself. However, this very large average papers over the fact that the distribution of private values is highly concentrated in the tails. There's lots of contracts with near zero values and some contracts for a select few firms that are very high in private value. We will then find that this estimated private value today, based on the stock market, has a positive correlation with the future contracts for production that the firm receives, but only those that are awarded without competition, which confirms this market expectation of this implicit guaranteed demand mechanism. We also find the firm size really matters, and that the positive correlation only holds for vertically integrated and large firms, meaning firms that have production capability, relevant production capability, which again, we will see how in the conceptual framework that excludes other explanations from being the ones at play and includes guaranteed demand as the primary mechanism. Now, there is a key policy implication to this, which is we are observing that a recent policy shift where the government is reducing its reliance on guaranteed demand, and it is increasing its reliance on competitive procurement, where even those follow-on production contracts are competed in the marketplace. And if that continues, then that could reduce large firms' incentives to invest in innovation that's directed at public missions. And so certainly that's an area that we need to consider how changes in policy, given our results, might affect innovation incentives for large listed corporations. Let me give you an example, though, because I think this is pretty abstract. Let's take the example of Texas Instruments, since David Mowery's quote used Texas Instruments. So here's just one example of a R&D contract award of $13.25 million awarded by the U.S. Air Force to Texas Instruments on July 1st, 1998 for defense aircraft engineering. Now, we wanted to see how did the stock market respond to this contract award. And what you see here, the high mark, the peak is July 1st, and the low point is July 2nd. So immediately over the next day, after the announcement of this contract award, after markets close on July 1st, the market tanked, the stock value tanked for Texas Instrument. Why would there be such a large drop in market value? How is it consistent with the idea that you get an R&D contract and your stock price drops? And by the way, the estimated loss in value, just using that firm-specific return, is about $1 billion from a $13 million R&D contract. That doesn't quite seem right. Are there any potential confounding effects? Did anything else happen that day for Texas Instruments? And the quick answer is yes. In fact, the firm announced that it sold its semiconductor memory business to Micron on the same day. So yes, there are confounding effects. There are other things that could be used to explain the stock market response. And our job is to try to understand how much of the stock market reaction can be attributable to the R&D contract versus other confounding events. And just the back of the envelope, applying the machinery on Kogan et al., we estimate that R&D contract's value, private value, based on its stock market response net of other confounding events, was about $442 million. And that sounds like a lot until you ponder that over the subsequent 5 years, Texas Instruments won government production contracts worth $627 million, of which $554 million were awarded without competition. So now that we think that R&D contract signaled under guaranteed demand future non-competitive production contracts with a very significant net present value, the figure of $442 million no longer stands out as being completely unreasonable. So moving from this example, let me talk about what we do to estimate the private value using the Kogan method. Now, in a world without confounders, where the only public announcement is the award of an R&D contract to the firm, the stock market reaction to that award would be the private value of the R&D contract. However, just from the Texas Instrument example, we know that stock prices move for a variety of reasons, and I don't need to tell this audience this, even over relatively short horizons. So what we observe, the observed stock market return, is the combined signal from the R&D contract and other announcements, which I'm going to term noise for the purpose of estimating the private value of R&D contracts. So mu FD is the true private value, And epsilon FD is going to be the market noise or confounders. The goal for us is to filter out the noise in order to isolate the true value of the contract so that we can calculate the private value. And Kogan et al. Provide us with, under some distributional assumptions, the correct formula to calculate the estimated private value of the R&D contract. And I will not go through the math. First, I wouldn't be the right co-author to do this. And second, I don't think we have time in under 40 minutes to do that. But let me just be clear about the assumptions that we make, so that later when I talk about the robustness checks where we vary these assumptions, you can understand where we're coming from. So a first assumption is that these R&D contract awards and other events are independently distributed, and that the private value of R&D contracts follows a normal distribution truncated at zero. What does that mean? It means that in the worst case scenario, R&D contracts are value neutral. They do not destroy firm value. This is the same assumption made by Kogan et al. For patent values. Why is it reasonable in our case? Primarily because the majority of R&D contracts are cost plus contract. So the government bears the brunt of the uncertainty and the risk associated with risky R&D work, where we don't know whether we'll have cost overruns or not. Well, the government carries most of that risk. So it seems reasonably to assume the firm, once they sign a contract, will not actually lose value from that process. We further assume that the stock market movements from other events follow a mean zero normal distribution, meaning on average, they neither create nor destroy firm value. And these are assumptions that we will play with in our robustness checks. We also assume the market ex ante doesn't know who will win, so they assign a zero ex ante probability that a given firm bids and wins an R&D contract. We relax this assumption in robustness checks. And then as a simplifying assumption, we assume that the signal to noise in the stock market is constant for all firms and years. And this is a tractability assumption, again, made by Kogan et al. As well. So let me tell you which firms we apply this method to. And of course, we can only use publicly traded firms because privately owned firms don't have stock prices. And we can only analyze firms following a policy decision to announce R&D contracts above a certain threshold on the day that they're awarded after the stock markets close. Other smaller awards may be announced 2-3 weeks, so the information about their grant reaches the market at very diffuse points in time, so we can't do an event study analysis of how does the market respond for them. So we are forced to use the set of R&D contracts that are big enough to be reportable on the same day that they were awarded. And so we begin with a Discern-1 sample of 4,520 publicly traded R&D performing US firms. And that sample originally covers 1980 through 2015. Of these first, 76% contract with the US government, meaning they win at least an R&D contract, a production contract, or both. And in case you're wondering, is this sample representative of sort of R&D in innovation investment in the US? And I think it is quite well. For example, in 2015, these firms invested in R&D approximately 89% of the total business funded R&D in the United States. So even though we don't have all firms, we have firms accounting to about 89% of all business funded R&D in the United States. Now, looking at our event study, we care about contract awards. And this figure here shows the total count or number of contract awards made to these firms, which is 782,000 over that 20+ year period. And then we will split them to give you a sense of how many are reportable versus not reportable on the day of award. They're all reportable. It's just some will take a long time to be reported. And here I also put the same day reporting threshold. So if a contract award is above $3 million, starting on April 1st, 1984, it must be reported after stock market close on the day of award. And you see that that threshold increases with inflation adjustment, 3.5 million in 2006, 4 million in 2010, et cetera. Among the reportable contracts, we really care about R&D. And just to give you a sense, what we will analyze is the 14,382 awards made to 239 firms that are reportable in R&D. That represents numerically a small fraction of total R&D awards, but dollar-wise, it represents a vast majority. The reportable ones account for 551 billion, so more than $500 billion over this period, whereas the non-reportable ones account for only 72 billion. So you see that the largest the contract dominates not by count, by the dollar value. So then the next question is, okay, we observe these reportable contracts on their award date. Does the stock market observe them? Do we have evidence that there's a reaction at all to the award of these R&D contracts? And so we run an event study where we look at days, 4 days before, 4 days after a focal R&D contract award, and we plot the share turnover rate for firms in our sample. And what we see is that the stock market impounds information about that R&D award very quickly. Immediately in the next day, we see a statistically significant jump in the volume of shares traded for the firm that won the R&D contract. And we run some placebo tests to show that this is not the case before April 1st, 1984. And that's the pre-policy of announcing them on the day of the award. And so that gives us confidence that the stock market does notices the information and impounds it in stock trading very quickly. And in robustness checks, we use alternative durations, such as the first 3 days after contract award, to test whether this particular 1-day window is too stringent or not, and with very similar results. The next question you might have is, okay, you told me you started with 4,500 firms, but now you're analyzing 239 firms. How are these two samples different? Is your sample representative for the Discern 1 firms? And the quick answer to that is, not really. The firms in our analysis sample are larger. They are less valuable, at least perceived as less valuable by the market, considering the market to book ratio. They are more R&D intensive, so they accumulate higher R&D stock values. And they tend to be more reliant on government sales, although I should note, out of the 239 firms, 17 derive more than half of their sales from the government. These are firms like Lockheed Martin, my former employer, General Dynamics, SAIC. Well, once we remove them from the sample just to look at what happens, the remaining 222 firms only derive 8% of their sales from the government. So these are not all government-captured contractors. In fact, I would argue the government represents a relatively small customer share in their total portfolios, with the exception of 17 firms who are definitely traditional government contractors. I want to, before we move on, just define 2 terms that I'm going to use, which is for the analysis sample of 239 firms, we're going to identify vertically integrated firms and large firms. But I want to be very clear here, vertically integrated means firms operating in at least one industry that supplied the R&D awarding agency with goods and services in the prior 12 months. Meaning vertical integration means manufacturing capability that is specific to that agency. So it's a much more targeted measure than more of a generic, what share of your upstream, downstream products are you producing versus buying from others. And then large is a relative size based on being above median in your industry sales distribution. So let me share you the results from just estimating the private value using the Kogan-All methodology. On average, the private value of an R&D contract is 466 million, with values ranging from 7 million at the 5th percentile of the distribution to 1,389 million at the 95th percentile. Now, to better understand these values, we're going to compare them with the total potential revenue from that focal contract. So when analyzing private values of patents, we don't know what the value of the patent is. But when we analyze the private values of R&D contracts, we do observe the face value of the contract, how much was actually obligated in it, as well as any options that the government may exercise further down the line if the development is going well. So that face value, base value, plus option value is what we call the total potential revenue from that focal contract. And so when we normalize estimated private values by that total potential revenue, we find that on average, R&D contracts are 19 times more valuable than just that total potential revenue. And we see that these normalized private values are higher for vertically integrated and large firms, so we have heterogeneity. Moreover, as you can observe from that histogram at the bottom, this distribution is really heavy in the low tail, so a lot of contracts have near zero value, and really long in the right tail. So there's a few firms for whom private values are really high. In fact, only 4.2% of the firms in our sample receive 5 or more top quartile contracts. So only a few firms derive a lot of private value from innovating for the government, which then brings us to the next step is, does the guaranteed demand mechanism explain these private values and the skewed distribution that we're observing? So in order to do that, to answer that question, the first step will be to study the relationship between these estimates and the sum of future production contracts awarded to the same firm. Here's a typical procurement timeline, and I've simplified it a lot, so bear with me if it's not fully representative of the complexity of what can happen. But we have a timeline on the horizontal axis, and let's say 6 months in advance of the focal day, firms bid on government R&D contracts. On focal day D, the government announces R&D contract awards after the stock market closes, as long as they're big enough to be reportable. On the next day, we estimate the private value using the Kogan et al. Machinery. Over the subsequent months, maybe even years, the R&D contractors innovate. They perform the R&D work under contract. And at some point in the future, let's say at year 1 later, the government awards the first production contract to the firm that developed the best R&D prototype. And I should note, empirically, typically the government proceeds with R&D across multiple paths with multiple different firms, and only in the last step is it revealed which firm had the best prototype that meets the government's needs the best. Over subsequent 3, 5, 10 years, the government then purchases additional batches of the product or service that was developed. So we will take information that we observe ex post about all of the future production contracts awarded to the focal firm to calculate how much future production did the firm get over the next 3, 5, and 10 years. And then we're going to try to run a regression where we relate estimated private values with calculated future production. And for the economists in the audience, this is a very simple regression. On the left-hand side, we have estimated private values. On the right-hand side, we have calculated value of future production with a set of controls and fixed effects. And the question is that we want to see is, does the stock market respond in a way that foreshadows the future production the firm will actually engage in? If so, then there would be a relationship, an association, a correlation between estimated private values today and calculated future production over the next 5 years, for example. And yes, we find that a 1 standard deviation increase in the value of future production contracts is associated with about 5%, 23 million, increase in the estimated private value of R&D contracts today. And even though this is unconventional in timing, because we have value today regressed on something that will occur in the future, non-parametric evidence is also consistent with the fact that there's a correlation. And we're not making causal claims here. We're simply saying that this is consistent with stock market valuations being forward-looking, and that coefficient estimates suggest that there's a positive relationship. The market impounds some knowledge or some anticipation of future production contracts. Now, the question is, does guaranteed demand explain this relationship, Or do other innovation mechanisms explain it? How can we distinguish between these? So we developed, and I should remind you, we have Ashish Arora on our project team. So we developed a conceptual framework to try to isolate guaranteed demand from other mechanisms. And the key to this conceptual framework was we were not going to assume inefficient government procurement, but rather under efficient government procurement. It's not that the government is careless and leaves money on the table by awarding these non-competitive contracts. No, we needed for the government to be efficient and still be able to disentangle through predictions guaranteed demand from other mechanisms. And while I will not go into the full conceptual framework, I want to summarize that we model 3 stages: a pre-R&D stage where the government chooses a procurement regime, either one of competitive bidding or one of guaranteed demand, where the winner of the R&D phase automatically gets the production contract. In the R&D stage, we model that as a contest between 2 symmetrical R&D firms, where the highest quality prototype firm wins. And the production stage is modeled as a second price auction, where we have end producers bidding under competitive bidding, or under guaranteed demand, the R&D winner automatically gets the production contract and then could subcontract it to one of the end producers available in the market. And we look at 2 types of firm heterogeneity across a key dimension. Do the firms, since they're symmetrical, have production capability? So we model what happens when they do and what happens when they don't. We make some assumptions. I'm gonna jump straight to what are the predictions of this model. The model predicts that we should observe production rents to R&D contractors, meaning a large value of R&D contracts is not just justified by the contract itself, in 2 settings. One, when the production contracts are awarded without competition. What's the intuition? Well, that implicit promise is only possible in the cases when the production is awarded without competition. If the firms have to compete on the open market with all other firms, there's no implicit promise. Now, this helps us differentiate guaranteed demand for tacit knowledge, which would give R&D awardees an advantage regardless of how the follow-on productions are awarded. And second, it predicts that R&D recipients must have production capabilities. And the intuition is only firms, R&D winners that have production capabilities can leverage them to extract additional rents from production by entering the production stage themselves. And this helps us distinguish guaranteed demand from a financing effect, which would benefit small and constrained firms arguably more than large vertically integrated production capability firms. So the next step that we take is to ask, given these predictions, is the association stronger where theory suggests it should be? And we find when we split not future contracts into non-competitive versus competitive, we find that the positive association with estimated private value is only there for non-competitive values. Moreover, when we add an interaction coefficient that captures whether the firm is vertically integrated or not, we see that the positive correlation only holds when the firm is vertically integrated for non-competitive production contracts. So these 2 empirical results, and we have additional robustness checks, I won't spend time discussing them here, suggest that what's really at play is not just tacit knowledge or just a financing effect where the government lowers the cost of producing R&D by subsidizing it through contracts. What we're observing is stock market responses impounding the idea that the firms operate under this implicit guaranteed demand promise, which is why the largest private values accrue to vertically integrated firms, and they positively relate to non-competitive procurement in the future. Now, of the other analyses that we engage in, I want to highlight one particular point. It's reasonable to believe that firms develop innovative goods and services for both government and private markets. In fact, I showed you that subtracting 17 government contractors, the remaining firms only get 8% of their sales from the government. So the private markets may be the real target in terms of where to sell that innovation. So an alternative explanation for the correlational results could be that the private value of R&D contracts simply reflects the firm's ability to leverage government R&D in private markets. And I want to tell you that that's not what we find empirically, meaning the private value of R&D contracts is negatively and significantly related to future private demand. So the large estimated values are not explained well by the firm subsequently selling the innovation in private markets. In fact, it has a negative relationship with subsequent private market sales. The other concern might be that this may be DoD. And this is a common concern when we study procurement is it's all DoD contractors, it's all Lockheed Martin, and this is only buying jets and fighter planes and things that go boom, which have no private market application, and therefore, what do we really learn for the average firm? And our analyses, our heterogeneity analyses suggest that is not the case. We find the exact same correlational results for all major awarding agencies with one exception, Health and Human Services, and with all major firm industries with one exception, healthcare. And this, I've promised myself I will raise this point in all talks. A lot of what we know about government support for innovation comes from healthcare, comes from pharma, biotech, and related industries, drugs. And yet, in my work using procurement, I have consistently found that healthcare, Health and Human Services, NIH, and the related firms behave differently than all other firms and all other agencies. So I just want to put a pin in that idea that what we learn from pharma may not translate to what we can learn about other firms in the context of government procurement. So to conclude, we believe we're the first to estimate this private value of government R&D contracts at large scale. We certainly find that the returns are concentrated in the tails. While most firms derive relatively little private value, a handful of firms derive a lot of private value from engaging on government innovation. We then offer evidence that the explanatory mechanism is guaranteed demand, that implicit promise to give non-competitive follow-on production contracts to firms that really excel in the R&D competition. But the firms that can do this are only those that have production capabilities and not small, constrained, specialized R&D contractors. The key idea then is that R&D contracts have this potential to crowd in private R&D investments directed at public missions, but only under the right conditions. And the reason why this matters is highlighted in the graph to the right. What that graph plots is 40 years of the share of non-competitive production contracts in all contracts. And we see a dramatic decrease from about 57% in 1980 to 34% in 2020. Due to a variety of policy reforms, the government has moved away from non-competitive production contracts. And now, while it's not zero, 32% certainly is about half of what it used to be. And if we believe the results, that this guaranteed demand mechanism has an incentive effect on large corporate R&D for vertically integrated firms, then we have to ponder how is the government's policy change going to affect incentives for large firms to invest in government-relevant missions. And I will stop right there. I thank you for your attention, and I look forward to the discussion.
Thanks, Larisa. That was incredibly clear. We're going to hand over to Kevin. Kevin, you've got 15 minutes.
Thank you very much. Let me just pop open these slides real quick. Give me 1 second. All right, I think we're good. Okay, so super interesting talk from Larisa. I'm going to give you a little bit of international evidence and a little bit of theory. But just so we're on the same page, for policymakers, I think this result is really interesting. So when we think about like how much does the government do to subsidize innovation, we normally are looking at direct figures, so like direct R&D figures. Obviously, there are many other things the government does that increase the rents to innovators or the return to innovation. And you know what you take out of this paper is at least for large institution R&D grants, the grant's like relatively unimportant on average compared to the follow-on purchase by government. And this is like an old argument on, what role does guaranteed demand from government play and how should it be structured in order to get the most innovation. Kind of the natural way to think about it is that you want to increase the return as much for all players who are doing work with spillovers. And since some of that work is a complement, so if you're thinking of something like Scotchmore Green's model of sequential innovation, if I need both the innovation and then the productization, I don't have enough marginal returns for the market actually to adequately incentivize everyone. So I need somehow to crank up those rents. So basically the remaining question is how exactly am I going to do that? So let me pull you out of for data reasons, we're using large firms in Larisa's paper. But normally when people think about commercialization guarantees, at least in the US innovation system, most people tend to think about startup related programs. So things like SBIR or STTR. I learned depending on whether you're an economist or in the private sector, you call these SIBRs or SBIRs. I don't think anyone really agrees on what the correct pronunciation should be. So in any case, interesting thing about these US systems, incredibly important programs for early stage R&D in the US. And you'll note we actually can, in phase 3 at a number of parts of the US government, we can sole source or non-competitively source innovations that were created out of phase 1 and phase 2 work. This is also true, over here here in STTR on the right side. This actually turns out to be, as I learned doing some consulting with other countries, very rare. So in Canada, very uncommon for R&D contracts to lead to sole sourcing. In the UK, very uncommon. In the EU, very uncommon. Essentially, most countries' governments have really moved away from allowing sole sourcing of final goods because I think, assume that this is leading to political corruption or insider dealing, and so they want procurement to be more open. The problem is, like, when we talked to, I did some work for a space agency outside the US, and they wanted to know how do we get more startups to work with us. And we said, well, like working for government is incredibly annoying. You're like basically the worst customer anyone can have until the numbers get big. And you have tons of paperwork and the timelines are long and the contracts take forever to sign. And so basically the only reason anyone's going to take a $200,000 contract that requires maybe $150,000 of R&D work is if that gives you some ability to get on, say, a qualified vendor list or to become a sole source supplier later on. So that's like the only reason any of these startups would ever take on these government R&D contracts, because that $150,000 they would spend doing the R&D, they would rather spend it on experimentation that allows them to kind of develop their core business outside government with their limited resources otherwise. So I think it's kind of interesting that despite the decline that Larisa shows you, the US is actually fairly unusual globally, especially for small firms, and how much we're using sole sourcing as part of our innovation strategy. So they're actually quite rare worldwide. Most places are separating the R&D from procurement. And we don't do that, I think, as was made really clear in today's paper. The normal caveats about the Kogan et al. Measures apply. We're at a finance talk. Those of you working on innovation, I'm sure, are already aware of the critiques here. But the numbers and how they match to later non-competitive contracts seem clear enough to me that the guaranteed sourcing plays a really important role. But should that be the case? So let me give you a really simple model, okay? Even simpler than the one Larisa mentions in the paper, okay? So let's take, I've got an inventor, one inventor, not two, just one, okay? The inventor can make a product of quality Q at some convex increasing cost. And then if I invent it, then I can produce it at some cost C of I, where maybe I'm able to match the lowest cost producer in the market, in which case I can produce at C. Maybe I can, can't produce it at all, in which case my costs are infinite, somewhere in there. It doesn't really matter. an outside producer, not the innovator, could produce at C. And the government can choose to sole source bundling with the R&D contract if they want. So what should the government do in this case? All right. So actually, this is an incredibly easy problem to solve unless I restrict things for the government more. So kind of obviously what the government should do, if they have perfect information about people's costs and their ability to innovate, is like just set the marginal product of the inventor equal to marginal cost, pay the inventor for the invention, and then have the cheapest producer source it. Okay. So this is actually, for those of you here from the finance world that are not innovation economists, if you know like one thing about innovation policy, you should know that innovation policy is about information rents. If we knew what we wanted to invent and we knew how costly it was to invent it and how costly it would be for various potential inventors to get it done, we would just procure it at lowest cost. Okay, so all the crazy things you see in the innovation world, from patents to sole source bundling of R&D and procurement with expensive producers, like all of that is because we need to have we need to give information rents to the inventor. Okay, so we don't know who can invent what, and we don't know what their costs of innovation are. What information rents do we give? So generally what we're thinking of is we're going to think in various parts of the innovation system, all the way from like the basic research down to the final production. We're going to think, where is it the hardest for the government to get the information they need to just do this at first best? And I'm going to give that player the largest information rent. This is just a rule of thumb, like it's going to hold in most reasonable models though. So in this case, you might think once the good's invented, if I'd already invented the kind of new product, like I don't know, a new turbine for an airplane, like I can just use auctions or many other mechanisms we have, even if I don't observe the costs of the downstream producers, to get this produced at close to low cost. I can run like a second source auction, a second price auction, or whatever your favorite, revenue equivalent mechanism is. So that part's relatively easy. The who can produce this part, you might think is hard, but since these are government procurement contracts, the government already is making a decision on who can produce it. So we're not actually using patents or prizes here. We are giving one firm a contract. So presumably, at least in this case, that part of the innovation system is not that hard. So what must be difficult, we must not be observing properly how hard it is for these inventors to create the good. Okay. And because of that, I need to scale up the return the inventors get over their true costs in order for them to have enough rents to be willing to participate in this world. In fact, I think maybe a better way to think about this is let's imagine something like this. I have all these inventors. They can work for the government, or they can just work on their private sector ideas. Okay. But they're resource constrained. So especially for smaller firms, this is always true. Even for larger firms, you're constrained on the number of R&D workers you can scale up. So I don't think it's that crazy. So we can either work for the government or we can work with the private sector. What the government's not observing is what I can do instead. So I think, okay, I'll give this person $200,000 to work on this R&D. Are they going to do it or not? Well, I don't want to get in a situation where I only get the lemons to accept, because all the people who are like really good and have good outside options don't bother. So what I'm going to do is I'm going to try to overpay the people that I do accept to avoid this lemon problem. So instead of just paying them right at the participation constraint, which I can't do anyway because the unobservability, I'm going to try to push them out of just working on private sector ideas towards stuff that the government wants. And one way I'm going to kind of give them that extra money is by sole sourcing the follow-on contract. So the question, I think, for folks in finance and even for like pure innovation economists is, even here, I'm a little bit confused on why I'd want to use a sole source contract. Okay. So there's many ways I can just provide a multiple of the costs I expect an innovator to have. So if I think the innovator needs $600,000 of rents in order to work on something instead of $200,000, I can just pay them $600,000 and then still have the most efficient downstream producer produce the good. So I think you really need, in order to like justify sole sourcing, you need some kind of assumption on this. The eventual sole source production needs to give the government information on this firm's thing actually works. And so when I'm doing the R&D, I actually care about the ability to translate that R&D into some kind of downstream production. Um, or I need some kind of spillover or inefficient production by learning by doing. So I want to kind of pull more firms into the production process for government out of some dynamic contracting sense. But the theory is so kind of strange that I think I would like to see that just explicitly laid out, because you know I'll always appreciate having a theoretical section. Here I'm still a little bit confused. I don't totally understand why a government in the relatively easy part of the procurement process, downstream production, is not just doing things efficiently and then just transferring rents at earlier stages. Like sole sourcing is such a weird thing to do, because it's a relatively easy place to get incentives correct. Okay, so all this to say, sole sourcing, the data in this paper is like compelling. Okay, very, very important for the returns to R&D for government contractors. The US government in particular is the single largest procurer of R&D in the entire world, and not by a small amount, by a huge amount. And so the systems that the US government uses to do procurement, really understudied by economists, including innovation economists. Sabrina Howell and friends have some nice papers on this, but otherwise it's like pretty slim pickings, given that we're talking about $500 billion. But the particular mechanism here, it's quite expensive. Maybe it's being used by the government to like commit to the downstream market, like to solve like relational contracting issues. Maybe it's being used to solve asymmetric information problems, and it's more efficient than other ways of solving it. But you know, if I was advising the government, having now thought about this paper more, I've actually become more skeptical of sole sourcing as a way to solve these commitment and asymmetric information problems than I was before I read the paper. So I both believe that I need to give more rents to the innovators because the spillovers are so big, but I also am not sure that this is the right way to do it. Maybe again, there's a public choice or some other explanation for what's going on. Okay, so perhaps we can discuss this in the discussion. I want to make sure we have time for questions, but the idea, totally correct in this paper. Imperfect market for technology, hard to fund R&D. I can't just fund my R&D out of selling the final product, because not all of us can even produce the final product at lowest cost. I need to subsidize the innovation. What do? I kind of give you a little extra benefit, a la a patent, downstream. But all of the same problems of like, when I have imperfect market for technology and I give you a patent and I can't sell on the right to produce to other people, like all of those continue to come up here. And might there be a better way to incentivize this type of R&D than the sole sourcing that we see is really important empirically? Okay, I'm going to stop here and move to questions. Thank you very much, Larisa. I learned a ton. Really appreciate the work.